Hi investors, welcome. I just wanted to talk a little about the open offer of Navkar Corporation, which is a very recent open offer that has come into the markets. I just found that there was very little information available on both Navkar as well as JSW Infrastructure, which is the company that has acquired Navkar Corporation. So I just wanted to spend some time to understand what is it that JSW does, what is it that Navkar does, what is the rationale for them going ahead with this acquisition, and then if there is any sort of decision you have to take with regards to how you want to play this open offer, what are the factors that should be influencing that decision. None of this is any buy or sell recommendation. I'm not a SEBI registered analyst. But I just wanted to speak out my thoughts on how do I see this acquisition panning out and how the different sort of changes would be taking place here. Right. So in this session, I'll first of all talk about the JSW Group and JSW Infra. Uh, I'll first talk about how JSW is a group that always slips under the radar. There's so much information about other groups, but we know very little about what JSW does. It is a company that is challenging Adani's domination in ports. This is about JSW Infra. Then we'll talk a little about the services that they make money from, and then we'll shift focus towards Navkar Corporation in specific. What are the services that Navkar provide? Why exactly did JSW Infra sort of acquire it? And what are the future plans they have in terms of the capex, the triggers that are taking place in the business? And what are some of the major risks that might play out for Navkar here, right? And then finally, we'll speak a little about what should influence your decisions to buy and sell, where we'll just give you a general model of how these open offers should be played. Technically, just giving an introduction about open offers before we proceed. An open offer is a regulatory requirement. It's a securities law requirement that comes into being when an investor acquires 26% in a particular business, right? So let's say that anything above 25%, if an investor acquires, they have to mandatorily do an open offer, which is an offer to acquire shares of the other investors who have a stake in the business. So if you are an investor, you have 25% stake in a business and you go to 25.01% stake, automatically that triggers something called an open offer where you have to put out an offer for the rest 26% shareholding, which will make it like 51% for you as the largest shareholder there. And there's a process of tendering that happens by other investors who then give it out to you so that you can become the majority shareholder there. Typically, like open offers can be played by an investor by taking a long-term view. Usually, the pricing sort of works in a way where if the price band at which like the shares are being acquired is higher than the current price, prices will move up and there'll be no like arbitrage opportunity as such available. But if you feel that the new company that is acquiring a badly run company, they can turn it around and you can see that change in operations coming up in like a year or two. That is like the way sort of that is the variant perception you create on this, and that is how you proceed with actually playing them, right? So, with that over, let's just talk about JSW Group and JSW Infrastructure, right? Um, this is exactly like all of the areas that JSW is present in. They're the largest steel manufacturer, and there's so much talk about Tata Steel being the frontline company, but India's largest steel producer is JSW Steel, right? They're a infrastructure player where they're the second largest private port operator in India. We'll talk more about this. They've joined the paints business with JSW Paints, and I think the capacity, the net block that they have set up is almost equivalent to the capacity that Asian Paints already has. So significant capex that they have put in there. They're also into the ventures business where they sponsor some SaaS businesses and platform pre-series A sort of businesses. They're a power producer in the energy business. They're in the cement business. They're in the EV business, and they're also in the sports business where they own Delhi Capitals and Bengaluru FC and Haryana Steelers. All of these teams in different sports. The interesting part here is that all of these assets that JSW Group owns, they are strategically very important to India. Right? As a part of government policy, when Modi came into power in 2014, they sought to ensure that steel production was based out of India only, and India wasn't importing any steel per se from, let's say, China, because China is the largest steel producer globally. This meant that a lot of companies within India, there was significant, like there was a down cycle that happened for steel from 2016 to 2017. And in that, many steel companies perished. There were about 45 steel companies in India at that time. Right now, there are only four major steel companies. So steel is a very strategic asset that is important for India, because India wants to consume its own steel rather than importing anything from abroad. Similarly, port infrastructure is a very strategic asset, because you want to have a certain sort of maritime control, because we have such a long coastline and such long waters and maritime sort of thing there. So in all of the businesses that JSW Group is present in, they own very strategic assets which are important for the country, and it usually slips under the radar, right? So let me just talk about like one specific example, which is related to a company called Nalva Sons, right? While everybody and their uncles were talking about how LSID investments was moving up, this is the share price of Nalva Sons, which is a holding company of JSW Group, right? It went up immediately after that announcement where SEBI said that they'll hold an auction for newer companies. It went up by some 60%, then it came down by 30%, and it has sort of started on the trajectory again where it has moved up by 40%. So this is a group that consistently, and similarly, if you look at JSW Holdings, uh, we'll see them logged in like continuous upper circuits for many days here, right? And this can even move further up from here. There's a slight correction that is happening today, but the entire idea is that there's no talk about the JSW group as such, but they're becoming like strategically very important for the country. There was this paper that Arvind Subramaniam and Raghu Rajan, I think, wrote, which was about how the new sort of industrial policy in India was affecting the economic outcomes. And they specifically mentioned two A's that were controlling like a large part of the economy, the Ambanis and the Adanis. But there was no mention of JSW at all in that. There's nobody who's like talking about JSW Group in the mainstream media. But if you look at them, they have strategic assets in ports, in steel, in new green energy, in green hydrogen, which is being talked about so significantly now. They're one of the pioneers in that field. They've set up like capacity in Orissa, in Rajasthan, in also Hisar, in their near their steel factory, where they're manufacturing like a lot of green hydrogen and they're using it to produce green steel. So they're at the forefront of these innovations, but nobody seems to be talking about it. And they're just generally slipping under the radar. And that is where like an opportunity for an investor really comes in, if you can understand what is it that they're exactly trying to do. Now, if you just talk about JSW infrastructure, right? And what is it that their business model is like? They're basically a private port operator and a service provider, right? How does a private port operator and a service provider make money? There are four ways in which you can make money, and I'd like you to imagine like being a port operator as being very similar to a parking operator. Let's say you own like a certain amount of parking spots, right? The first service that port operators provide is marine services. And marine services are essentially about, let's say that you are docking your ship, which is coming in from another country, onto the port. It would need to be tugged in by ropes. It would need to be attached to a particular place so that the loading and unloading of cargo can take place. That service is provided by the port. Let's say that there was a parking space attendant that also provided you the scope for parking the car for you in the correct places, and they like charged money for that. That is exactly the first source of revenue that JSW Infrastructure has. They provide marine services, these are called. Secondly, they provide loading and unloading sources. So imagine you brought in like a huge car, which had like many gifts that you had brought in for Diwali, and you would and some parking attendant help you put that into the parking spot. After that, they also helped you in unloading the gifts that you had brought in, and then they asked you for a commission. So similarly, when a ship docks on a port, the unloading that happens, it's not done by the owners of the ship or the companies that are sponsoring. It is done by the port operator, and they charge a fee for that. So that unloading and loading is the second segment here. Third is the transport of the cargo. Now, going back to our example of the Diwali gifts being taken off from the parking spot, they would need to be transported somewhere. Let's say to your house, or let's say to a relative's house or somewhere else. JSW provides, like, infrastructure provides that services for the cargo that comes in from ports too. So they take your thing, and whether it is like in a solid form where it's in these big containers that would be transported across, or it's in a liquid or a gaseous form that will need to be transported through pipelines. They have all of those infrastructure already available with them. The land, sort of the solid cargo, it's either transported through rail or it is transported through like actual land transport through trucks and other things. They have the facilities to do that, and they charge a commission on the basis of that. Finally, there would also be like some sort of storage involved. So let's say that the requirement for the cargo that is coming from another country isn't there in like some city within India for the next 15 days. It need to be stored really well. So if it's like something which might be perishable, it needs to be stored in a cold storage or something like that. JSW again charges fees for that. So they charge fees for this, and they earn a very impressive EBITDA margin. If you look at their EBITDA margins on, like, the best EBITDA margins that they've done is about 53%, because this is primarily a services business. The assets that they own are significant, but it's mostly like the revenue that they earn is from churning these assets and providing services to customers. So, 53% of EBITDA margins there, which is pretty significant. I think last quarter they did about 51 or 52%, which is because of some repairs that were going on. The significant part about this is that the third party revenue for JSW Infrastructure is only 49% currently. 51% of it comes only from the other group companies. So let's say JSW Steel is asking for some sort of raw material to come in from another country. Let's say they're purchasing like raw steel from, although I think that does not happen, but let's say they're purchasing some raw steel from China, and it is being transported via like the waters, and it has come to the port. JSW Steel will then give money for all of these four services to JSW Infrastructure so that they can supply this to to their place, right? And then once you have like this basic context on what exactly is it that um, uh, JSW Infrastructure does, we can move on to understand what is it that Navkar Corporation does. There are two basic services that Navkar Corporation has. One is a container freight station, and the second one is an internal container depot, which is called an ICD. So CFC and ICD. CFC is a sort of warehouse which is used for containers which don't have like huge volumes that are being transported. So let's say you're a very small importer exporter, and you don't want to own the entire warehouse. Your capacity isn't enough that you would want to own the entire warehouse or rent it out for a specific point of time. You just have a very small piece of the warehouse that you'll be using, which is like the case for most of the importers and exporters. What a container freight station would do is, let's say your shipment is in red here, they would take it to a container freight station. They would sort of store it and deconsolidate it according to like how it needs to be shipped out further within the country, and they would prepare it for delivery, and then they would ship it out to the destination that you have. So this comes in like a huge batch which is like being unloaded from the port, which includes your shipment and also shipments of thousand other people. This will be consolidated and then sent out to your shipment to the place that it needs to be at on the basis of the services that are provided at a container freight station. Now, there's also something called an ICD, and uh, you would have seen like ICDs as, if you ever travel by train and you see these big container sort of terminals that are there within the land regions, landlocked regions. I know, for example, that in Delhi there is a place called Tughlakabad where an internal container depot is present. The entire point of this is that they provide the same services that a CFC provides, but they provide it like closer home as compared to closer to the port. So let's say that you were shipping something out from Mumbai to Punjab, right? And it starts out at Mumbai, where a container freight station sort of sorts it and tracks your shipment and sends it across to, let's say, Delhi. And Delhi has like a major internal container depot. The internal container depot would again do the work that the container freight station would have done, but it will do it in a landlocked region, and it will then supply your thing to Punjab, which you wanted to send it to. So that is how it typically works. And typically, all major cities have this internal container depot, which can be used to supply these different materials. And so Navkar Corporation owns a bunch of container freight stations and ICDs. But there's also like something very significant with Navkar Corporation where these four things sort of come in. So let's just write down four assets here. The reason why JSW Infrastructure was interested in acquiring Navkar Corporation was that they had like four assets. One is a bunch of container freight stations which were close to the ports that JSW had, especially in Maharashtra. They had like several internal container depots, inland container depots, and they had a significant land bank which was there in Maharashtra, closer to the ports. At like a few places that JSW owned, and they had a CTO license to operate railways. A CTO is consent to operate, and basically it provides you with the ability to use the railway lines to transport this raw material across the country. So they had certain capacities to make sure they could have like inland transportation of the material that was being like docked and undocked from a ship, right? And that is these four assets, I think, sort of made sure that JSW went for this acquisition. And chiefly amongst them, I think, when it comes to like container freight stations or internal inland container depots, JSW can build them out. But when it comes to the land bank that they had, which was very strategic and important for JSW, and the CTO license that they have, these two factors sort of became very significant reasons why this acquisition actually took place. So focus on this. Now, to understand why exactly JSW Infrastructure went in for this acquisition, you need to understand what are the services that uh, Navkar Corporation can provide. And we've given you like four reasons for why Navkar had assets which JSW sort of wanted. Now let's go deeper into what were the rationales for this acquisition, right? The first one is that JSW Infrastructure wanted to get into different services from just a logistics company vantage. So they knew that they were in the services of, marine services or loading, unloading services and other sort of services that we mentioned at the top. But they wanted to penetrate deeper into the inland and get into different regions of internal transport and build themselves out as a logistics company as rather than just a port operator, because I think they were seeing certain opportunities here in terms of expanding internally, and that is where the license that Navkar had in terms of CTO became very important. Secondly, they wanted to become a complete distribution provider from the port angle as well as from a delivery and distribution lens. So again, it's about a logistics company thinking more along the lines of that we just don't want to operate the ports, but we want to also be in charge of the actual delivery that goes to people at the end. And we also want them to like benefit from this, right? There are three reasons that they have provided. This has come from their con call. There are certain port operations which would benefit because there is a land bank that Navkar owns, right? You can use that land bank to further expand the port operations, make them bigger and perform better. There are also like certain container freight stations that they own, which will make them better. But then when it comes to inland logistics operations, the significant thing here is the ICDs that they own, as well as the railway sort of CTO they have. And these two things would enable them to both do better on the ports front as well as the inland logistics front. And that is why JSW Infrastructure went for this acquisition in the first place, right? In terms of the vision that they want to, the vision that they provided for how they want to build this out, they want to create a wider network across India, right? So essentially, like if you're doing well at the ports and then you're also doing well inland across different regions from where like this would be transported, you're doing well across this entire network. And then if like the port assets are consolidated and much more strategically placed, and let's say if you have two ports in Maharashtra and like operate permissions to operate like smaller ports, permissions to operate major ports which are like smaller in terms of revenue contribution for you, which are all in Maharashtra, all surrounding Mumbai. There's a company that owns certain assets in, let's say, Palghar. Automatically, that makes sense because the asset base for you expands, and that is why you can become like much more integrated in your options. In terms of like capex, they said something like they want to change this to a lease model. I didn't exactly understand what that meant. But I think this is one of the risk factors that you should keep in mind. They were saying that they didn't want to put in money into the company directly, and they didn't feel that there was a need to. One, first of course, because the assets are already in place. But secondly, they said something about the lease model. I think this is one of the major risk factors that an investor should know about. And they secondly said that they would be looking at more acquisitions coming along their way, just like Navkar. So this can also change like a lot of things. But after this acquisition, just want to speak a little about the plan that JSW Infrastructure has in terms of doing certain things with Navkar Corporation, right? They want to increase the business more robustly and integrate it with the other locations. So if the port land assets are only concentrated in Maharashtra, they also want to integrate it with their other ports asset in, let's say, Andhra Pradesh or some other region, right? And they want all of this to be integrated into one like internal logistics whole that can enable them to transport it across like different regions. The deal will be consummated in Q3 FY25. They have said that they'll start to work more deeply with this company, but they already have a blueprint ready in terms of what they want to do. And you can broadly understand what is it that they want to do on the basis of like information that we've already provided. The internal logistics growth will come into focus with this acquisition. So they will mostly build out a proper internal sort of logistics network with this acquisition, and that is what they're trying to do. They'll increase the utilization of Navkar assets, and they'll utilize other assets of JSW to make it better. Capex, again, as I said, there is no plan to actually do some Capex for Navkar as of now from the basis of the con call. In fact, like the acquisition just got completed on 11th of November, 9th of November, I believe. And that means that there is very little like actual change that has happened on the ground, but there are certain plans that are in place. And amongst them, like in the 1 year that is going to come up now, they're not looking to significantly expand the asset base through capex or other things. So there is nothing which is happening of this sort. But there are certain very interesting figures that are going to play out in Navkar Corporation. Right. So the acquisition was completed on October 11th. So I said November 11th, but it's October 11th. And the control of operations has been assumed for the business. They're now in the process of starting with the best practices incorporation. So all the best practices that JSW has with regards to how it operates its ports and the other assets that are attached to it, they're trying to do it for Navkar too. Navkar Corporation's financials will be incorporated into JSW because it's a wholly owned subsidiary from October till March 2025. There is a port called Morbi where there are certain assets that Navkar owns. These were planned by the management that Navkar had before this. They were planning to utilize them in the next 1 or 2 years. Uh, and it had come into existence only 6 to 8 months ago, right? So this asset base is something that will come into effect very quickly. And Morbi is a significant port in the state of Gujarat. So there is some sort of turnaround that you can see in terms of operations because of the Morbi asset coming into play. The assets don't need any repair or a proper turnaround. They just need like better utilization, is what the management said. The management has also guided that this can come along in the next 2 years. Also significantly, the next CEO of JSW Infrastructure is an ex-IRTS officer. And IRTS is Indian Railway Transport Services. JSW Infrastructure has only made like port people chief executive officers. This guy is a very interesting person because I think he was also like the chairman of the Dredging Corporation of India. So he has like significant experience in operating and learning about ports. But he's also a railway services officer. So all that internal logistics that we talked about, all that CTO license and things that we talked about with Navkar, those sort of changes will get incorporated into Navkar. Now, I'll just talk a little about the risks that are there in this business, right? There was something called a direct port delivery, which was introduced for importers and exporters like about 2 or 3 years back. The idea of an internal of a direct port delivery was that internal cargo depots that we talked about, internal container depots, what happens at them is that there are certain customs regulations that exporters and importers have to comply by. And these customs, like officers would often sit at like ICDs. To make that process of regulation much more convenient, government introduced a direct port delivery scheme, which said that instead of going to a container freight station or an ICD, you could get these services from I think local sort of offices that are there across India. Uh, what the so this was a question that was asked to the management, and the management said that in terms of policy, the damage that TPD had to do had already been done, and the ports, the internal ports as well as the ports which are sea facing, they have a limitation to handle the DPD. So the amount of uh, DPD services that can be availed from across, like from not reaching a port, that is very limited. You have to actually go to a port to avail all of the suite of services that are needed for exporting and importing. So they feel that this is not like a significant risk, but it is one of the risks that has come in the past, right? Secondly, increasingly a higher percentage of the revenue will come from the group only. Now, this is a big risk because this point, right? Open offers typically only tend to work when the intent of the company is to use the assets of a newly acquired business to actually make a profit from that business, right? Because we won't be investing in JSW Infrastructure, we'll be investing in Navkar Corporation. And the only way you can be making a profit out of this is that Navkar supplies like its services at like a significant profit margin, right? That can only come about when it is not used as a supplier. So there's this company called Sangi Cements. Uh, which was acquired, Sanghi Industries, in fact, which was acquired by Adani. And what they did with this was that they started to use these resources that the company had to make them a supplier for Adani Group. So there was initial interest in this company because the open offer had taken place, but then it sort of corrected because the company is not able to earn the kind of margins that it should, right? So if you look at Sanghi Industries and you look at the margin trend, it hasn't. So see this has gone into negative margins. This is just like making a 2% margin because it's being used as a supplier for uh, the Adani Cements assets for I think ACC and the other sort of companies. So this means that the margins can correct significantly if you're using a company as a supplier. Now, when you look at JSW infrastructure, most of its revenue also comes from the services that are provided to the group. Will Navkar be used as a customer? Will Navkar be used as a supplier to JSW infrastructure? Will can also like lead to a depression in the margins. But the interesting part here is that, as we discussed earlier, JSW infrastructure also supplies most of its services to the JSW group. But somehow they're able to maintain like a very, very healthy EBITDA margin here, right? And this shows you that it is not entirely impossible for Navkar to actually earn a bigger profit, even if most of the services they're supplying to would be to the JSW group only. With regards, so this is like a big risk factor. If they use it as a supplier, you can forget about it actually making money. It will go below the open offer price. There'll be no significant change. It will benefit the JSW infrastructure shareholders. The second part is whether Navkar will be merged into JSW. So if you look at JSW, 65,000 crore market cap. Navkar is a smaller company, 2,000 crore market cap. If they're integrated and merged, the ratio of that merger will not be favorable to Navkar investors, not be favorable to the people who are playing the open offer. When the management was asked about this, they said that a decision has not been made yet because, of course, they had not even fully assumed the control of operations in this company. It is from that time. So they said that they'll take a call as time passes by and they'll inform all investors. So if like any of these two things sort of play out, if Navkar is either used as a supplier or if Navkar is merged into JSW Infrastructure at a very weird swap ratio, it will not make money for investors. But in terms of just like decisions that influence your buy or sell, you need to keep like two things in mind. One is the open offer price, and I think in this case it was around 115 rupees or 120 rupees, something like that. Currently, the share is trading at 136 rupees. That is like one price point that you should be very mindful of, right? It should be used as a support whenever there's a significant correction. The lowest risk entry would be at that price, the open offer price. But there's another significant variable here, which is in terms of the book value. Right? 130 rupees per share is the book value of the assets that Navkar Corporation owns. It is trading at 136 rupees currently. If there is any sort of turnaround that takes place in the business, we don't know the kind of scale that Navkar Corporation will have because most of the things that we talked about, they're not modelable. There's a reason why I have not presented an Excel sheet with regards to how much revenue it has currently, how much revenue it will have tomorrow, next year, 2 years down the line. That is because it's not possible to do it. It's just a bunch of plans that a management has thrown up, right? So the only way you can safeguard yourself as an investor if you want to play a theme like this is buying extremely close to these two support prices that I mentioned, either the open offer price or the book value per share price. If you do that, you would be exposing yourself to minimal downside risk, but but you will also be capturing in case that there is an upside to this, you will also be capturing the upside here. The risk factors remain the fact that if it is used as a supplier or if it is used as something where JSW Infrastructure is using the assets of this business to increase its revenue, that won't essentially like work. But prima facie, from the looks of it, this is like a separate business addition that they're doing. So this won't be the case where certain assets are being used by JSW Infrastructure in a particular way. I think the revenue benefits will accrue to Navkar Corporation, apart from possibly the land bank being utilized in a certain way that can go in any direction. But I think mostly the benefits will come to Navkar Corporation. But then the second risk sort of becomes is, will they merge it with JSW Infrastructure? And investing is all about just looking at these risks, and you only make money when these risks are sort of eliminated. If we didn't have these risks, this price would have been like anywhere. There was also briefly like a time where this share rose up to like some 160 rupees or something. Just give me a second. Yeah, so it went up to like 160 rupees here. And this was the bull market. There was just too much information with regards to what was going to happen in this business. This was significantly up from 30% up from the open of it, 40% up from there. There was like a lot of noise with regards to what would happen here, and they just led to an increase in price. But this was a bull market. We're no longer in that roaring phase of the bull market. There's going to be some sanity. I think the market is going to wait for some results, but the only way you can save yourself is buying closer to the book value price or to the open offer price. So that is it in terms of the discussion.